One of the golden rules in trading is that you have to protect your trading capital. Without capital, you don't have a business. And while a store may be able to get a line of credit, traders are not high on the loan officer's list. Using a stop loss in trading is a smart move to protect you when the random distribution of wins and losses plays out with you on the losing end. You can think of a stop loss as a limit order that's resting in the market to take you out of a trading position that is not having positive feedback in your traded direction. When hit, the stop loss order, the limit order, is going to be turned into a market order, and it's going to be filled at the best possible price. Since a stop loss order, when triggered, turns into a market order, all of the risks associated with a market order, such as slippage, applies. Now, wouldn't it be great that if every time the market hit our stops, it carried on moving in the same direction for a significant move? Yeah, it doesn't. But that's the reality of trading. Markets can sometimes take out your stop and then reverse all the way to where your profit target originally was. And this can lead to a situation where you have trouble taking your stop loss order when price is approaching. Forex traders, for example, they've seen that happen many times in their trading career. A well-placed stop loss order gets taken out to the pip, and then the market reverses direction. And I know that I have personally lived in that frustrating world a few times in my trading career. And frustration can lead to emotional decisions. And in trading, anything that's emotional does not have a positive outcome. A stop loss that's placed in a location that makes sense due to the volatility of the market, it can be ticked out and the market can head to your original profit target. And if this happens too often, a trader is going to be hesitant to take the stop and move their stop further away from price action. Stop losses based on a percentage of account that gives you your position size and gets moved further from price increases the overall risk you've applied to your trading account. And that has the potential for a really bad ending. And it can be hard in life to look back in time at the positive events when your life is currently in shambles. In trading, it is much easier to look back at individual trades where being ticked out occurred than it is to see when you were stopped out and the market kept going. Failing to do that will have traders not taking their stops, and that is a trading error that you have to avoid. Traders have been known to alter their entire trading plans to compensate for an error as opposed to testing and fixing the error. Tracking the true cost of any trading error is an enlightening exercise, and it's easy to lose track of the actual difference in your P&L, especially when there are trades where you get away with an error. So taking the time to dig into your trade log and figure out the true cost is an important exercise. Look, you're going to get stopped out in your trades, and the probability of being ticked out over many trades is pretty high. Let's say that the probability of your stop getting one ticked out before the market reverses the target is 1%. Well, if you take an average of 4 trades per day for day traders and 20 trades per week, the chance of a one tick stop out before the week starts is 18%. Now that starts to be significant. The market can make you feel like it's going to one tick your stop out more often than it actually does. The way it approaches your stop can be nerve-wracking at times, but there are plenty of times when it's going to reverse before it actually hits it. But that feeling can work against you when you move your planned stop before the market reaches it and then it doesn't turn. If you're placing your stop loss in a location that has a relationship with the reality of the market you're trading, a stop out shows a change of character in the market. Maybe it's based on volatility. It's based on previous swings. Maybe it's placed above or below significant turning points in the market. If your stop is placed in a location that, if broken, shows a change in the market, you will not be the only one looking at that location. You may expect further flow into the market at those points, and you do not want to be on the wrong side of momentum coming into the market at your stop loss location, the one that you just moved. In this graphic, the potential resistance zone is a high valued area where previous shorts will defend their positions. The risk is that traders will place a stop loss too close to the zone and get ticked out when the zone would hold. Remember, these are never precise price points, and that all chart patterns and structure must have a built-in margin of error. My stops are generally a measure of ATR, the average true range, and take into account swing points that might be close by. In the example here, a technical analysis trader shorting at the consolidation level as their trading strategy may measure the height of the consolidation pattern and then place their stop loss the same distance plus a buffer away from the trade entry. Even if you're trailing your stop loss order to be taken out of the trade with a profit, you still want to ensure that your stop is in line with the context of the market. Now, trailing stops can certainly add to your bottom line, but they must be done according to a tested trading plan or at least in line with current volatility. And if you're regularly getting stopped out just before the market turns, it could be that there's something in need of attention in your trading plan. So keep track of your results over time and assess whether the number of times it is happening is reasonable or not. But even if you take a few unlucky one-tick stop outs over a small sample of trades, it could also be that you're just experiencing a market streak. When something happens in the world, markets can change their behavioral characteristics quickly, and an increase in volatility could mean that your stop is now too tight in the current market environment. This behavior may not last, but it certainly can leave a mark on a trader's psyche. A paranoid trader not wanting to get cheated out of their money can add a large number of ticks to their losing trades, far more than the few stop outs that they save by moving their original stop. Recognition of the cost of not taking your stops is the first step to correcting the problem. The second major step is to see that over time, the chances of this happening become far greater. Mentally rehearsing your stop when you are unsure of whether the trade is going to continue much further against you is a powerful exercise to prepare you to execute your trades as you have planned. And inevitably, sometimes the market will just take your stop and move on to profit.